After a strong turnaround from the year's lows, equity markets have swiftly reclaimed their one-year highs and are now in proximity to their all-time high levels. The Sensex and Nifty indices have gained around 17% each since July when the markets began moving north. Analysts expect this positive momentum to firmly sustain going forward and believe it is time to turn the market strategy away from defensive plays to sectors like banks and NBFCs.
And with all the challenges from the global markets, especially the inflation numbers which are now cooling down, and very soon, within 2 months down the line, we are expecting the interest rate cycle will also start to peak out. So given this kind of a scenario, market players have already started anticipating that there is going to be a shift from a debt to equity at a global level. So India too will get certain share of foreign equity which was missing from quite a long time, the foreign growth. Domestic investors are definitely pushing a lot of money. All the margin related challenges and the pressures that we have seen in the coming quarter, it is likely to get mitigated by March quarter. And with a lot of capex activity which is going on in the market, and with the banking sector now getting turned into positive side with a better credit environment, we definitely feel after 2 to 3 months down the line, markets will definitely start making new highs. And it's definitely more good time to get into a high beta stock where we can make very big money.
On the bourses, banks and capital goods have seen a sharper run-up since July than healthcare and FMCG packs from the defensive category. While the BSE healthcare and FMCG indices have gained 16% and 9% respectively from July, the BSE BankX and capital goods indices have rallied 26% and 28% as compared to a 17% up move in the Sensex benchmark. A.K. Prabhakar of IDBI Capital prefers domestic bets over FMCG and pharma pockets, which are facing headwinds from weak rural demand and high raw material prices.
Because the market momentum has totally changed. It is more to do with banks, capital goods, and QSR, and hotels. So sectors, which are more domestic led, is doing very good. So pharma is out of focus, and FMCG due to the inflation pressure and rural stress. There also I'm not too gung-ho about it. But selectively, auto is also doing good. Like you see, commercial vehicles or passenger vehicles, they are doing good, and auto ancillary is doing good. So and defense related stock is one more sector which is doing good. So slightly restructuring your sector will be always better, so that you don't miss out on the opportunity which is there now.
The sectors that are set to take the lead in the next market rally will be banks and capital goods players, according to analysts.
So as far as sectors goes at this point of time, so definitely banking and financials are looking pretty good. Because they are coming out from almost last 4 years of consolidation. So last 6 months has been really good. So all the data points are showing us that yes, this is one of the sectors which will start taking a lead. Along with that, there are lots of sectors into this cap goods, engineering, infrastructure-oriented companies. Even for that matter, cement companies also are likely to do good. The fuel prices coming down for these cement companies, and with lot of capex which has already been done by these companies in anticipation of better demand.
That said, markets will seek direction from their global counterparts today. Globally, investors will also track existing home sales in the US and retail sales in the UK. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.